Let's begin with the obvious. A memo went out to your employees and your clients today about a restructuring at Bridgewater. Tell me about it.
Well, what we want to do is formalize a partnership structure so that they're able to be, there's actual rules about partnership, a designated group that is partnership. Wanted to formalize that because we're going from a company in which I led the company in this way, our idea meritocratic way, and now we're going to something that might needs broader and more formalized partnership. So it would be like if you were going to have McKinsey as a partnership. Goldman Sachs has a partnership.
Once upon a time, they were a partnership.
They were a partnership, and then it's a good example because when they have a partnership, they still have to maintain that partnership way of being, and yet they're a public company. We're not going to ever be a public company.
Never?
But no, never, never, never. But that notion of creating a structure so that there is a partnership structure and plays a greater role needs to have some formalization, and so that's why we're real excited about it.
How will it work?
Well, we're in the process. Of figuring out how it works. But the way it is mostly is there's been a group of designated preliminary partners. There are
seed partners.
They're called 6 seed partners and 50 other partners. And
these are the senior people at the firm.
Senior people, generally speaking, but people who have been there a certain number of years, all the things that you would think would represent partnership in terms of decision-making capabilities and the like. And we, Bob, Greg, me, and all have established that group, and then they have to decide how it's going to work. So we're not part of it, so that we have the total freedom. There's a board. They will have board representation because they're there are the owners and so on, just like in the Goldman, in a sense, where there would be.
These partners will have equity in the firm.
Have equity in the firm. A lot of them already do, but they'll continue to have more equity in the firm, and then they'll have their board representations on the board, and then the CEOs really will have to. They'll evaluate the CEOs, and so that's how it's going to work.
David and Eileen.
So that that process will, operate by the partners who then report to that, and then there's a board that is overseeing that, representing also the owners, and as there's a transition. That's part of a transition process in which.
Over what period of time?
Well, we've done most of the transition in terms of equity and the like, a lot of it, and so I think that probably over the next 3 years or so, we're going to do a lot more. But most of it's been done, and we needed just to formalize their decision-making capabilities.
The most interesting thing you said there was that the partners are going to decide.
That's right.
What Bridgewater is.
That's right.
That's a big change.
Well, I don't think so.
No?
No, I mean, it's a big change in that it's formalized. Okay, but the way that we operated all that is this idea meritocratic way. I mean, like they were all idea partners.
Radical truth, radical transparency.
Right.
So you feel that these ideas have been surfacing for a long time already?
Well, we've been doing transition over a gradual period of time, as you know, for a number of years, right? And so this is just a step. This is a great step in terms of like formalizing it. What does it mean to be a partner? What are your decision rights? How do they get together and evaluate the CEOs? Those kinds of things, being much more.
These will be systematized.
Systematized, and a lot of it has to be worked out, right? So we're at the stage really where we've assigned the partners. We've stepped aside. It's up to them to do that, and we're excited about it.
Are you at all afraid that Bridgewater at some point in the future will no longer be the idea meritocracy? It won't stand for radical truth. It won't stand for radical transparency. The things that you've obviously championed, believe in, and enshrined in your principles?
I don't worry about that because the issue is everybody has values. What are their values? What is the culture? So the important thing is that it's up to, I don't worry about it. It's their lives. And it's like raising kids or being around a certain environment. Like it's up to them now. And the important thing, I think, is we've all come to value this. I would say most. And so we have a certain culture that people have come to appreciate, and then it should evolve. And it'll probably evolve to be a better way. But the important thing is that they own it, right? And that it is theirs, because you don't want to control their lives. That's why my whole transition, I'm so excited about the transition. Wrote the book, pass it along, do these things, and then they own it like you'd want to own have your 35, 40-year-old kids. You want them to own it, and then it'll evolve. So we're thrilled about this.
Just like it is with your children, you probably have some ideas about what these partners and the firm that they continue to build is going to be like. What do you think they're going to change, if anything?
Well, I think they're improving things in the way like this partnership concept, right?
Whose idea was it?
Well, it was a number of people really came about. It seemed like a natural evolution of how do you capture the particular. So it would be hard to say whose idea.
Well, was there a moment?
No, it was evolutionary, you know.
Wasn't something that David floated, for example?
No, it wasn't. There wasn't a person like that. It was just the evolution where you start to say, how do you operate in a partnership kind of way where, let's say we think of the future, and you think McKinsey has a partnership. So we studied different companies' partnership models. We spent a lot of time doing that to think that's what we want it to be. I think we all wanted it to be that way, right? And so there was no one person. It was really collectively, instantaneously, pretty much.
Is this, in your mind, a necessary step Bridgewater has to take to remain a successful, thriving, and growing firm?
Yes, I think it needs. I think it benefits a lot from the clarity that we're going to have. In other words, a greater amount of clarity regarding what makes a partner, what your decision rights are. It's like a constitution. So it's going to be much better, I think, by having that type of clarity.
I can see from your perspective how it helps the firm, how it helps your employees. How would you say it helps your investors?
I think that what the most important thing for the investors is the commitment of the people and what the culture is like, right? And the fact that we have a company where these people who've been there for many, many, many years are so committed to the culture. I would say you look at that and you say, wow, that's a great team. I'm going to be as much involved in the investment decision making as possible. But think of me as being more of an employee. I'll be a CEO. I'm a chairman and a CEO. But my investors are excited about the whole transition, of how well the transition is going.
Was it important to coach some of them through this, to talk to them?
Well, always we're explaining what it is. You know, at every step along the way we explain it. But
and I presume it also has the backing of your outside investors. Like
everybody, right.
Boomers, for example, or Texas Teachers, their shareholders in Bridgewater.
I'm not going to speak on their behalf, but, I would say our partners, everybody thinks that this is one of the best thought out transitions from a entrepreneurial leader, okay, to a team of people that have worked there for a long time. Bob Prince has worked there for 31 years, 32 years. Greg Jensen's worked there 21 years. Eileen, all these people, and they got a sense. They know us up close, and they know that there's a tight group, a culture, and there's a certain way of doing things. And the fact that it has been done very transparently with them. I mean, a lot of people don't even announce that they're going to have a transition or they don't have it worked out. We've been radically transparent, and they see it step by step. So they see it as a good step in that direction. And they know all the people, because people hang around too long, and yeah.
Well, longevity is clearly a dominant feature among your employee base. Do you think, to the degree that you don't have it in some places, this is going to improve retention?
I think so. I don't think on the margin it's going to be that big of a deal, because a lot of the people we always spoke to, we always treated them like partners and so on. I think that what it'll do is it makes it clearer, and all that clarity is a good thing.
Does it make Bridgewater any more attractive to potential employees, applicants, the kinds of folks whom you're always looking for and increasingly competing for with other companies?
Again, I would say the fact that we've always operated in a certain way is really the way that it is, the idea meritocratic way. So it operated a lot like a partnership without the clarity. So we're bringing clarity to that. What is exactly your decision rights? How would dissatisfaction with a CEO be determined? Who will have what responsibility as a backup? It's really that clarity of the partnership that I think is going to be the most important thing.
You describe this as being a natural step along your journey.
Yes,
that
that's right.
included writing the book.
Yeah, that's right.
What do you do next?
Well, first of all, again,
in that journey?
I've always, the passion since I was 12, I've played markets in the economy, and I'm going to do that as long as I'm welcome to do that at Bridgewater, so that's what I'm going to do. But what happened is, think about it like I would do maybe an 80-hour week. Now what I've done is I have something that might be a 40-hour week or a 40 or 50-hour week, and that frees me up to do all the exciting things. I'm right now trying to transition well. That's why I'm passing the book, and I'll be passing the tools along to help other companies. We'll put that out. And then there are lots of things that I'm excited about. I love spending quality time with my family. I mean, I would say I've got 2 grandkids. It's a kick to be around them, 3 now with a young daughter. So it's that kind of stuff. But I'm also excited about the philanthropy in all different which ways. I'm excited about ocean exploration. I got too many things that I'm excited about, right? But it's still markets and the economy and being involved in the game. I mean, that's pretty much, encompassing. You got to keep the eye on the ball.
So let's talk about that for a moment. You have likened the current state of global tensions, populism, and the economic backdrop to what the world knew in the 1930s. And we all knew where that ended, with a genocide and with a world war. Where are we headed now?
Okay, so let me clarify what I mean by that. Okay, I think everything in history repeats over and over
Yes.
again. Sometimes
over very long periods of time.
Some things happen only once in one's lifetime. Because let's say, for example, the debt crisis. So let me give you what I think is going on. I think that the 2008, 7 to 9 financial crisis was very similar to the 1929 crisis in that there was too much debt. You hit 0 interest rates. It's the only other time they hit 0 interest rates, and we had to do quantitative easing. And that's what they did. We bought $15 trillion worth of financial assets. That puts assets higher. And so just like in 1933, in 2009, when that happened, financial assets rise, and that there was a recovery. And that time, it was up until 1937. But we still had these wealth disparities.
Right, very uneven distribution.
Very uneven distribution for a lot of reasons. And so if we look at today, the top 0.1% of the population's net worth is equal to the bottom 90% combined. And that's very much was the same in that particular period. And let me just clarify the so there was that, and also a sense that the system isn't working for us, and as a result, populism became more the case. Mm-hmm. So if
people question democracy and they question capitalism,
right? And because is capitalism working for the majority of people?
Tell me, is it?
It is not working adequately for the majority of people.
Would you say the same for democracy?
And democracy is questionable in terms of how it's operating. I mean, don't get me wrong. I'm a capitalist. I'm in the business. I love capitalism. I believe it. But it's got to work for the majority of the people. So then the other thing that was happening in that period of time is when a rising power it comes in conflict with an existing power, like much the same way. It's called Thucydides' trap was what it was.
So now we have Germany and the UK, and now we have China and America.
Right, and that Thucydides' trap. There's a wonderful book by Graham Allison about this, and it goes back 500 years. And whenever that exists, then there's more likelihood of conflict. War. There were 16 times. In 12 of the 16 times, there was war. Okay, so when you have that doesn't mean you have to have war, and I'm not predicting war. I'm not saying anything like that. But what I am saying is, let's be clear. There's a wealth gap, okay? And so populism is an issue. Populists are a certain type of personality that they're aggressive and so on. So we're in a situation where these forces are analogous. When we look forward, I think that we have risks. And that risk is of the next economic downturn. Because, so anyway, I'm going on a little too long, but that'll give you the picture.
Well, no. I want to continue talking about this. Let's talk about the risks. The risks in the financial system today, the risks to investors, people with capital, are different than they were clearly in 2007, 2008. What would you say are the principal risks in order of importance?
Okay. Well, as far as the debt crisis then, we calculated that we would have a debt rollover crisis and that we would have a debt. We don't have that. But we have a situation in which the number of IOUs that we have in terms of not only debt but health care and such, pensions and so on, are a lot.
Unprecedented now, right?
Are a lot. So there's more IOUs that can be dealt with. And that's a problem. And as we sell more bonds into the market, because we're in the process of having a larger deficit, and we also are running down the balance sheet, that's supply demand. But I would say, let's say, if I take three things in terms of what I would say the three most important issues of our time will be, other than the cycle, how we deal with this next downturn, how will we deal with that? I want to take just a second on that downturn. If you have a downturn and we're so much at odds, I think it'll be a difficult time. And I think that you can get more political polarity. The left can be more extreme, the right can be more extreme. So I'm worried about that in that time. But longer term, the three things would be, how well does capitalism get reformed in a way where it's working for the majority of people? And how does democracy?
More people feel like they're benefiting, more people feel like they're invested in it.
That's right. In a way that creates incentives that pay for themselves. That I'm not talking about just social programs. I'm talking about enabling and empowering that people. We have to deal with that. So that's issue. Number two issue, not in order of priority, is the relationship between the United States and Japan, China, and then of course other countries, as we come into a rivalry. How is that rivalry handled? Will that be handled peacefully or will it be antagonistically? And then the third thing is information management, data, big data, and artificial intelligence. So when we look at the world 10 years from now, or 5 to 10 years from now, and that's not so far, I think we are going to see a world that'll be very different depending on how we handle the world in terms of data and artificial intelligence, how we're going to use it, will be a different world. The world in terms of that conflict or competition with China is going to be a big deal. And then that issue of whether we can operate as a country as a whole, in which we don't have the factionalism in the country, so that we are united against common principles and pull together to be effective. Those will be the three things, I think.
Can I go back for a moment, Ray, to the point that you were making about the amount of debt that's going to have to be sold to fund these commitments that we've made and the deficit that the government has created? Who's going to buy this debt? And at what price?
When we calculate who are the buyers and what do they represent in terms of the percentage of the portfolios, it looks to us like that there is more debt being sold.
Yes.
Then we'll have a problem.
More supply than demand.
Yeah.
So prices are going to have to go down.
And so, well, I think then what will really happen is that the Fed's selling program or reducing its balance sheet will then go at a slower and slower pace than is planned, okay? I think that they'll be reactive to that the circumstances will produce a weakness in an economy. Because if you have an interest rate that rations the demand, the way that happens is that reduces economic activity. And you can't, and so the Fed's job is to deal with that notion. So I think that the Federal Reserve will slow down the rolling down of the balance sheet, or terminate it, or if things get bad enough, add more to it in terms of that process. So I don't think the tightening is going to be as big as is expected, because I think it'll affect asset prices and so on. So I think at the end of the day, you're going to probably see a change in the nature of monetization or rolling down the balance sheet.
That's going to be the net effect.
Because the consequences of selling all that debt. I think the bigger issue when we're dealing with it is that all countries around the world, because of the United States' role as a reserve currency, are holding a lot of bonds, an amount of debt which is larger than they would ordinarily hold. I think there's a classic cycle of reserve currency. And so that just has to be, that's something to watch.
Does that mean they're going to sell it?
I don't think that they're going to sell it. I don't think it's going to. I don't think it's going to happen, but it has to be watched. I think they're just not going to add to it like we would want them to.
So, and are we talking there about the Chinese and the Japanese large holders of U.S. government debt?
I'm not going to comment on any entities.
But they may not have the same appetite for U.S. government debt going forward as they have had in the past.
I think anybody acquiring so much, if you have too much already in your balance sheet, and you're operating in a different way, I don't think it lends itself to acquiring the amounts that need to be acquired.
So, if you're right, and the Fed slows down the roll-off of the balance sheet, is that going to moderate the rate at which and the point to which yields rise?
Yes.
And okay.
It'll lessen
So where's
that
that going to
pressure.
be? What's if can we concoct a clearing price, a clearing yield for treasuries?
I think if they didn't cut their balance sheet, that bond yields would go to about 4.5%. And but they can't go to 4.5% without hurting all the other assets and hurting the economy all that way. That's why something else has to give, because I don't think they're going to make it to 4.5%, because everything then starts to all assets trade off of the same discount rate. So in other words, when we're looking at stocks, bonds, private equity, real estate, and so on, they all have a same sensitive to interest rates. So
where then do you think the 10-year will peak if it's not at 4.5?
I would say probably.
And that's
but it really, this is an imprecise thing, because the feedback loops in terms of the more interest rates rise, discount relative to what's discounted in the curve already, the more all assets have that as a negative thing. So we're talking about that adversely affecting asset prices before that. It would.
So what are the implications in this scenario, Ray, for other assets like equities, for example?
Well, I think that what we call risky assets are assets that tend to go up in a growth environment. They're assets like equities and so on. So I think you almost have to look at what are the assets that don't do well in those types of environments. The key is really to have a well-balanced portfolio. So so that'll be our.
Is now the time to hedge?
I think now's the time to have a very well-balanced portfolio, and to take a look at the big bear markets. I mean, I'm sure I'm going to be misunderstood. That portfolios have good times and bad times, and they go through the cycle. And when you're late in a cycle, as we are late in a cycle, and when you have central banks having a tightening of monetary, interest rates don't rise much. Balance is always good, but it's particularly important to have balance at this time.